Okay, thank you, Rob, for including your own paper on the program. And yeah, Rob and Xuran are both here to answer any tough questions you guys have. So before I get started, I want to say that this is actually not that, an uncontroversial topic. When I told people I'm studying this, and some people's reaction is, well, insurance companies are not really exposed to climate risk because their contracts are short term. They can just reprice every year. When climate change gets worse, they just charge higher premiums. And obviously, I think a lot of people in this room probably see the problem with that argument. We heard a lot about affordability. So when you increase premiums too much, a lot of people can't afford it. And the demand is going to fall, and that's not going to be great for insurance companies. But if you look at these insurance companies' regulatory filings, where they started disclosing their exposure to climate risk, actually a lot of them do say, well, we don't have to worry about climate risk because we can just reprice. And we also know there are frictions with the regulatory approval process. The regulators are not just going to approve every rate increases, especially in risky places where the public is very unhappy with how high the rates already are. So I want to start the talk with just a quote from one of the insurance companies' disclosure, their climate risk disclosure. So this is from Progressive. When I teach, the students hate it if I read the slides. They would complain about it, but here I'm going to just have to do that. So for Progressive, we believe that climate risk often manifests as weather risk, losses and loss adjustment expenses are our largest liability, and catastrophe events can potentially impact our pricing risk and availability and cost of reinsurance, and these events may be becoming more severe and less predictable. So the bottom line is Progressive agrees that climate is not great for them. And AM Best, as the leading insurance rating agency, also agrees. So they look at a bunch of risks and they say climate risk is one of the largest, most important risks that insurance companies face. And they also say that insurance companies are not ready to face the complex challenges of climate change. So we know that some of us agree that insurance companies are exposed to climate risk, but how do we quantify it? So this disclosure effort is great. Insurance companies talk about, how they are exposed to, but it's all words, right? How do you put numbers to those words? How do you say, okay, which insurance companies are more exposed, which are less exposed, how worried we should be about them? So here in this paper, we kind of propose a methodology to put these things into numbers. So we could rank insurance companies and we can follow them over time and see how their risk exposure is changing and whether we should worry about them. If there is a big climate event, what would be their potential capital shortfall? So it is an important question for both consumers and regulators how exposed insurance companies are and whether climate risk is affecting their financial stability. And insurance companies can be exposed through two channels. So far, we've been focusing on the physical risk channel, meaning that as climate change gets worse, there will be more disasters, how these property casualty insurance companies can withstand these shocks. And on the other hand, life insurance companies with their huge portfolios can also be exposed to another risk related to climate change, which is the transition risk, meaning that a lot of assets in their portfolio, $180 billion of their corporate bonds, that's 15% of their entire corporate bond portfolio is in fossil fuel companies. And if those assets are going to be banned in the future, then a huge chunk of their portfolio is going to lose money or see the value evaporate. And that could be a problem for life insurance companies and the role that they play as financial intermediaries in this market, in our economy. So our approach is based on stock market, and the data is readily available. And for now, our analysis is only focusing on public insurance companies. But we are trying to devise kind of extend our analysis to also apply to private insurance companies. And I will talk about that. And one challenge in measuring climate risk is that in the past, we have to use kind of historical loss data and say, okay, in the past, insurance companies, suffer these losses, they operate here, but we don't know how climate change is going to evolve, right? It's definitely not reflected in the historical loss data. And another thing is insurance companies are also going to change their strategy, their operations in response to climate change. And that's not going to be captured in the historical data either. So what we do is we use this market-based approach. Basically, we're asking the stock market to tell us how much they think each insurance company is exposed to climate risk. So let me explain how we do that in plain English. So we construct a portfolio, a physical risk portfolio. So the idea is you pick a bunch of stocks and basically put together a little mutual fund kind of thing. And how we pick, and we are hoping that this stock portfolio should fall when climate risk gets worse, okay? And then we look at how each insurance company stock co-move with that portfolio. So if the insurance company's stock goes down when this portfolio goes down, that means this insurance company is going to be more exposed to physical risk. So we do the same thing for transition risk. We have a portfolio of stock returns, basically using the brown industry minus the shorting the green industry. And that tells us how whenever there's transition risk increases, say regulatory risk, Biden got elected, that's bad for this portfolio, and which insurers can move more with this portfolio, that insurer is going to be exposed to more of this transition risk. Okay, so what we find that property casualty insurance companies that have more operations in states that we consider risky do have a higher sensitivity to our risk, our portfolio, our physical risk portfolio, meaning that our approach is somewhat validated using the operations data. And we can also look at the life insurance companies, comparing their actual corporate bond portfolio. We find that those that hold more brown industry bonds, they have higher exposure to our transition risk factor, our transition risk portfolio, meaning that our measure using their stock price is validated using insurance companies' actual investment data. So our key finding, number one, is that we find smaller property casualty insurance companies have more exposure to climate risk, and their exposure has been growing in the past few years. And this goes back to Perry's presentation. We're seeing a lot more smaller insurers going into those risky states, taking on those risks that the larger insurers don't want to insure. But these smaller insurers, in our estimates, have much greater exposure, potentially because they're just very much less diversified. And we also look at life insurance transition risk exposure. We find that their capital shortfall, if the transition risk goes up, meaning that a lot of these fossil fuel assets are going to be basically stranded, then these insurance companies' exposure actually has been increasing. They are not kind of shifting aggressively away from these risks. Okay, so I mentioned that we put together a physical risk portfolio or factor. How do we do that? So we have many different ways of doing it in our paper, including one method using many public companies that's outside of insurance space. So we look at each company's exposure to climate risk and kind of just rank them. So that's another methodology. And here our main focus is using property casualty insurance companies. So what we do is we form a portfolio of these property casualty insurance companies, and we give them weights every year, different weights every year. So how do we assign weights? We say those that have more business in the risky states, they're going to have larger weights. Okay, just ignore this formula. Here just to show you that we didn't make this up. We actually have some math in the paper. So this is our portfolio's return after disasters. And there is a very strong negative response in our portfolio returns to disasters, meaning that when disasters happen, this portfolio does badly. So when climate change gets worse, there's going to be more disasters. This portfolio is going to have these negative shocks in response to those things. And here is our validation exercise. So on the vertical axis is we look at how each insurer's stock co-moves with that factor, that portfolio that we created. So if it's more sensitive, it has more correlation with that factor, then this beta, this insurer physical climate risk beta is higher. And on the horizontal axis, we forget about this whole stock market data. We look at where insurance companies do their business, and we look at the states where they do business, how risky that state is, using the state's muni bonds exposure to our fiscal risk factor. So these two kind of have a very strong positive correlation if I run a regression. Here I'm just showing you in graphs. So this says our methodology has some validity, and it also gives us a way to measure private insurance companies' exposure. So we can look at, for the private insurance companies, we don't have their stock trading data. So we don't have their stock price to calculate their sensitivity to our portfolio, but we could look at where they operate and that state's market-based sensitivity to our portfolio and construct their operational-based climate exposure index. Okay, so then we do a stress test. We say, okay, let's imagine a scenario that's really bad, but has happened in the past. So it's a 1 percentile tail return of this portfolio. And say in that really bad climate scenario, how much capital shortfall insurance companies will have. So here's a pretty graph. Here we are plotting out these smaller insurers in our data. And these smaller insurers have seen an increase in their capital shortfall under a potential stress scenario. So we think these data could be useful to industry and as well as regulators. So next, we also look at life insurance companies' transition risk exposure. As I mentioned previously, we found this portfolio that's mainly about having these brown industries and shorting these green industries. So if the brown stocks go down, these factors are going to go down. So here, this Paris Agreement was really bad for this portfolio because the risk of these brown assets being stranded went up. And on this side, when Trump got elected, that was really good for this portfolio. So this portfolio is capturing the risk of these brown assets being stranded, being banned in the future. So here we look at life insurance companies' stock sensitivity to this portfolio. And the higher means that these insurers are more exposed to oil and gas industry, brown industry. And here we are looking at forgetting about their stock price, stock returns. We're just looking at the corporate bond holdings at each bond level, and we look at how much exposure their corporate bond portfolio has to the brown industry and calculate their climate beta based on their portfolio holding, and these two line up. So this is, again, validating our method based on their stock performance. So here's another pretty graph. We can see some insurers are really loading up on their exposure to the transition risk, while some other life insurance companies are kind of decreasing their exposure. Okay, so in the remaining time I have, I just want to quickly talk about another piece of work that is very related to the theme today. So in this paper, we look at how insurance rates are affecting the housing market and how that's related to climate change. So in this paper, we look at flood insurance rates, because here, flood insurance rates are somewhat set by basically politics, the politics in FEMA and in the Congress. Rather than whenever we see a home insurance rate increase, the risk is also going up. So we can disentangle the effect of the risk or the effect of rates. So here we can do that. When FEMA increase rates on some homes, but not others, what we find is home values went down, and the effects are really large. So for the houses that are not exposed to sea level rise, for $100 of premium increase, we see that home values went down by $4,000. But if we look at coastal homes that are exposed to sea level rise, this effect is $25,000. So you may say, wow, this number just seems astronomical. How is that possible? So one explanation is that when FEMA raised rates, they said, well, we're going to keep raising rates in the future as risks go up, and we're going to have the rates completely reflect the risk in the future. So people are expecting these rates are going to go up, especially in those coastal homes where the risk of flooding is higher. And on the other hand, we think that people are also updating the perception of risk. So when home buyers think, well, I can just buy FEMA flood insurance and cheaply hedge away these flood risks, these climate risks, then they're not really thinking about carefully assessing those long-term risks that they can't really put a finger on. But when they see these rates going up, they're suddenly waking up to these really increasing risks of climate change, sea level rise, and flood. So we think by aligning insurance with the actual risk that's underlying all these assets, we can better incorporate these very long-term risks into asset values today. And that can potentially also discourage more development and more migration into these really risky areas. Okay, I'll end here. Thank you.
We actually do have time for questions. There's a misprint on the printed program that you have in front of you. Thanks, Matt. A misprint on the program. It's off by half an hour. That sounds like a big error, and it is. But it really means that both Shan has time to answer questions and Lawrence has time for his presentation. So question, Frank.
I was just curious. First of all, thanks. So simple and so clean. I really like this paper. I was just thanks. I was just thinking about the way you emphasized physical risk for property and casualty and transition risk for life. But I can imagine, and this is a question, not a statement, but I can imagine physical risks in the life context as well. And they're trickier because they're not tail events like fires or hurricanes or floods, but just, the gradual increase in temperature and associated gradual increases in sea levels and so on lead to gradual increases in heat stroke, in heart attacks, in diseases from mosquitoes and things like that as the sea level rises and we get more marshy sorts of areas. So I'm just thinking about those sorts of physical risks, but even in life contexts, is there a way to capture that?
Mm-hmm. Yeah, it's a very interesting question. I think it's empirical. We could actually look at that, but theoretically, or just, if I try to theorize or hypothesize, it's not quite clear. Because on one hand, life insurance companies sell a lot of annuity to older people who are more vulnerable to these things. And for them, I don't know how to say it politely, but the older people dying sooner is not a bad thing in that case. Really didn't come out well. Sorry.
Well, a friend of mine once put it as a cure for cancer would be the best thing that ever happened to the annuities industry. Yeah. Well, no.
And for the rest of the population, also the unfortunate thing is the less advantaged population is more exposed and more vulnerable, but they're also less likely to have life insurance. So that's just my theorizing of what might be happening, but that's something we could look in the data. Yes.
Perhaps you could, I'm just not fully, sorry. Maybe you could just, I know what a stranded asset is. That's not the question. And I'm intimately familiar with the discussion on stranded assets, but I don't know, like if you're a life insurance company and you own bonds, a portfolio of bonds that are fossil fuels, like, are you assuming that there's this jump move tomorrow that they become worthless? Or because otherwise, like, there's plenty of time to divest those portfolios to replace them with other bonds. I don't understand the concept there.
You mean why we look at it or?
Yeah, in other words, if I'm a life insurance company and I own a portfolio of brown bonds,
Mhm.
like I'm hard pressed to think of a scenario where there isn't plenty of time to divest those, to sell them, exit them, let them mature, let them roll off. Like
Mhm.
they're typically based on energy companies who have massive cash flow. They're probably senior in the capital structure. Maybe they're not, but like, so I'm kind of missing the point where it's not as though you're an equity holder owning a coal mine that could be written off for, I don't know, maybe my question
Yeah,
isn't making.
yeah, it certainly makes sense. So based on what you were saying, we shouldn't really see insurance companies really being exposed to by holding the bonds of those, assets that can potentially be stranded in the future. But the fact that we do see that when the brown firms stocks go down, the insurance companies who hold a lot of those brown firms bonds also go down. We don't see a lot of other explanations other than, it's their portfolio exposed. Colin?
Yeah,
Just while I was getting to my quick question, and if it's longer, we can talk later. The two questions regarding the slide, the $100 premium and the $1,000. How big of a sample? And what if the prices went up 200 or 500? Is there any correlation to what that would happen to valuation?
Yeah, our sample is around 8 million homes in total, but for the coastal homes, we have more than 1 million. And we cannot extrapolate to a super large premium increase though. Mhm.
Thank you.
Sure.
So Sean, I had a kind of a follow-up or related question to Michael's actually. Also focusing on the portfolio of brown bonds. And I guess I have two parts to it. One part of it is if the market is sophisticated and understands what these companies hold in their portfolios, and the value falls in their portfolio, whether it's brown bonds falling today, or maybe it's just interest rates rose and so bond portfolio fell in general, then the market should understand that the company's worth a little bit less after that happened than before it happened, without necessarily, but that just strikes me as a tautology, right? Like that's going to be true for anything that they hold in their portfolio. My related question is that to hypothesize that these bonds are going to do much worse over time kind of suggests that the market's very inefficient in pricing those bonds. So we're saying the market is efficient in pricing the insurance companies that hold the bonds, but not very good at pricing the bonds themselves. And that seems kind of contradictory.
Yeah, that's an interesting point. So one thing that I omitted is that insurance companies also hold some equity, not a lot of equity, but quite some equity in these. So some old number is a $10 billion of equity in oil and gas, but that was like 10 years ago. So maybe now they hold more, maybe some of the exposure is from here. I guess one could also say that the corporate bond market is just less efficient because, it's over the counter, there's a lot of liquidity issues, while the equity market is more liquid and people things may get impounded into prices more efficiently.
I smell another PhD thesis here. So with that, I know we've got lots more questions on this and great paper, Shan. Thank you.
Thanks.
And Rob and Xuran.